Hello, everyone, and welcome to the first Austmine webinar of the year. I hope that you all enjoyed a safe and happy festive season and that 2022 has started off well for you. I'm Sheldon Varco, the Membership Manager, New South Wales and South Australia here at Austmine, and I'm pleased to be joined by Paul Mitchell, the Global Mining and Metals Leader at EY for today's webinar. Before we begin, I'd like to acknowledge that I'm hosting this webinar from the lands of the Gurungai people, and I also acknowledge the traditional custodians of the various lands on which you all work today and the Aboriginal and Torres Strait Island people attending this webinar. Our year ahead webinar with EY has become a fixture on our schedule at the beginning of each year. From today's session, you'll receive valuable information about what to expect from key commodity markets, risks and opportunities in the industry, and the major trends to keep an eye on for business leaders. Paul always brings great insights to the session, leveraging his significant mining industry experience. And following his presentation, you'll have the opportunity to ask him questions. You can use the Q&A button at the bottom of your screen to send your questions over at any time. You can also upvote on other audience questions that you most want answered. I definitely encourage you to use this opportunity to receive some expert insights from Paul today. So without further ado, I'll hand over to Paul to start the session. Welcome, Paul, and thanks again for joining us.
Great. Thanks, Sheldon. Thanks to Austmine for putting this on. And I'd like to acknowledge traditional owners as well. I'm coming from Gundara country, so Southern Highlands of New South Wales. So a little bit different to my usual, but like a number of people, I escaped the city during COVID, and our offices are locked down at the moment. Look, as Sheldon said, this is an annual report we put out, so we'll take you through the presentation. I'll try and spend about 35-40 minutes on that and leave some time for questions. If I miss any of the questions, we'll grab details and we'll get back to you. So don't worry if we miss you. We'll try and answer your question at a later time. I generally like to start with a bit of a look forward at the market in terms of where we're heading. And we're actually extremely positive about the outlook at the moment, not just for 2022. It's always dangerous to say you're confident about the market going forward, but we're actually confident that the good conditions will continue for 3 to 5 years. You can see there, the commodity prices. The gold and iron ore that are in red are just because they were just record highs. $135 iron ore yesterday. Iron ore producers are still making good money at that rate. The coal price is the one that I think surprises a lot of people, but obviously with shortages around the world. I think driving this is energy transition. Which surprises people. Why is met coal looking good for energy transition? But the first part of energy transition is building the infrastructure so that we can actually generate renewable energy, particularly for the southern hemisphere. There's not a lot of that in place. And so to do that, you generally need steel or aluminium. So, you need that met coal. Hydrogen will replace it at some stage, but it's not commercially viable yet. And it will be some time. Is our perspective. Iron ore will continue, seaborne iron ore will continue. The recycling rates remain very low in China, so we're extremely positive about that. Copper is then obviously critical for energy transmission. The renewable energy doesn't tend to be close to major public centres. It's not like you can build a big solar farm right next to a city. So you need to transmit over greater distances, and then obviously storage is going to be the third part of energy transition. So we're seeing lithium. Finally got some great price curves on lithium, but we're also seeing nickel and zinc, and at some time we'll see hydrogen, I think, as a storage positive as well. So I think Omicron has given us a little bit of a blip. We've seen some cases. ESG is obviously playing a big part in what's happening in our world. We'll talk about that in a lot of detail when we go through our presentation. But it's generally looking positive, and I generally think that will last for 3 to 5 years. So we'll do it. I always warn people when I make predictions like that to say that I still work for a living, so I'm obviously not that good at predicting commodity prices, or else I would have retired a long time ago. So take it with what it's meant. Our risk report. This is our 14th year that we've done the report. We get a fantastic response when we put this out. We go out globally to NEDs and C-suite executives around the industry. There's a little bit of a bias to producers in terms of what we do. They tend to be the people we react with, but it is producers of all sizes. So it's not just the major conglomerates in terms of what we do. It's right across the board. And I think the first thing you really notice about this one is the impact of external or societal factors. The first four are all clearly external factors, and that's really unusual. Typically something very operational gets in the top five. Workforce one, or productivity or cost reduction. We had digital up the top for a number of years. And while those ones are still in there, we're being really dominated by ESG. The first three, so we've got ESG as first, decarbonisation as second, and licence to operate as third. We could have put as one. So we could have brought them together and just said, look, ESG is the number one issue. But it was so overwhelming that those three issues were the top that we decided to put them separate, and we decided to distinguish them a little bit. And I'll talk about how we've distinguished them when I come to those risks. But it was overwhelming, and it was overwhelming across all geographies in terms of what's there. I thought decarbonisation was going to come number one. I did a preliminary presentation to a client and said it'll be decarbonisation without any risk, because that's all anyone's ever talked to me about the entire year. But it was actually ESG, and that. So while that was a surprise, I was actually really happy with that outcome, because what that says to me is that when people thought about the risks for 2022, they were looking forward. So they weren't saying, what are the risks that we're facing right now? And this survey was done in the lead up to COP, so it would have been very easy to put in decarbonisation. They were thinking about what's coming, what's heading there. And that says that there's a recognition in the industry that broad ESG factors will continue to impact us for a number of years and will continue to drive the industry in terms of what we do. And that while decarbonisation is a very important factor in that, it's only one factor. And that other issues like social impact, water, biodiversity, those things will become more and more important. And depending where you are and depending what the issue is, will depend on which of those is the most important to you. So really, a great outcome in terms of what we had there. I think it's worth sort of just reflecting. A lot of people thought that technology or digital would be what would disrupt the industry, and we certainly had some feeling that would come. It didn't drive immediate disruption. It drove changes in terms of the way we operate, but it didn't change business models in the way that technology and digital has for retail, or for media, or for telcos, or for other sorts of industries that we've seen, where technology's just driven complete disruption and complete change in business models in terms of what's there. It didn't have that effect. But when you add technology and then these social factors, that's having a big disruption. And so that's good, and it's a point to watch. But what it says is that disruption is going to happen. It's going to be significant. And when there is significant disruption, there's opportunities. There's opportunities for current participants, there's opportunities for participants on the service side, and there's opportunities for new participants to enter the market, which could be really interesting in terms of what's there. So I think the mix of those two really drove that. And I like to sort of think, that's because when you mix them together, they impact all of those things that are critical to mining. they impact access to resources, they impact people, they impact capital. It's all of those factors that are impacted. And I think that's why it's what's driving our disruption. The other big question I often get asked when I present this is, what came first? Was it CEOs actually genuinely being interested in these factors and genuinely wanting to change, or was it some other factor? I think it's both. And I think, when you sort of look at it, there is the initial change was created in new demands from capital markets. When you've got such a capital intensive industry, capital markets can drive change and can drive action in terms of what's there. So, the sudden realization of capital markets that happened over about a 3-year period really sort of drove boards and CEOs to sit there and think, hey, something different's happening here, and to drive that sort of change. But if you look at it, boards and CEOs had already started to make some of these changes. They'd realised that brand needed changing. They'd realised that they needed more diversity. They'd realised that change was there. Plus, when the average life of a CEO in the sector is 5 years, then you have generational change in those CEOs every 3 years, every 2 or 3 years. And so I think when you sort of mix up the impact of the capital markets, the impact of other stakeholders, and generational change, you've seen that these societal factors have lifted up in terms of their importance and in terms of what people are focusing on as we move forward. So I think, it's a bit of both. It's mining companies wanting to change, and it's mining companies being told to change, and they've come together. I have not talked to a CEO in the past 3 years that said to me, this is rubbish, I'm going to ignore this, I'm going to move on. Anyone who did that wouldn't last very long in terms of our industry. So I think that we can take that as an extremely positive factor. Let's talk about ESG. Let's sort of look at this one first. So when we talk ESG, we've focused on environment and social factors, and we've focused on environment without the factor of decarbonisation in terms of what's there. So, quite an interesting one in terms of where we're going. I think, there's a number of things, as I said, that people are looking at going forward that they're sort of thinking about. A big one that came through was the water energy nexus, was that realisation that water intensity is significantly greater when you're using renewable energy and biodiversity. I think too, we're starting to see a standardisation of ESG measurement and reporting standards, and we're starting to see some positive changes in terms of there as we move along. A big watch point for us on ESG is mine closures. And I think, poorly closed mines create issues for us and will continue to create significant issues. I don't think a mining company that wants to continue an operation can afford to close badly anymore. In the old days, you could get away with it. Now I don't believe you can. There are a significant number of mines that are set to close over the next 5 years. And for the mines that had closed in the past, there are rehabilitation performance targets that have been missed. So this is going to be a really big issue in terms of what we do. Closure is not just about closing the mine and rehabilitating it in terms of what's there. It's a multi-risk challenge, and it impacts a broad range of stakeholders. And I think the big one that's been recognised lately is communities, and being able to manage through a just transition for those communities that depend on the mine and have some link to it for employment or for wellbeing in terms of what's there. So I think being able to sort of think through what that transition will look like means that you need to start planning your closure even earlier. The good thing is planned closures are much cheaper than unplanned closures. So, best practice is plan your closure at the commencement of your mine. Not many people do that, but we're starting to see more and more people starting to think about planning closure 5 to 10 years out from the end of life of mine. The problem, of course, is when is the end of life of mine? We tend to extend those things as we go, but the sooner you can start planning that, the better in terms of what's there. The world's top 20 miners have provisioned $40 billion to close existing mines. So doing this well is going to be critical for the way we operate. I think the other big one that's going to come through, and we're going to see this particularly in Australia, is how will mine closures impact broader society? So, not just the local communities, but the communities, but the whole of local communities that depend on revenue. What are the governments of WA and Queensland going to do to broaden their industries and to broaden what they focus on in terms of what they're doing? And I think those sort of issues are going to start to come to the fore as well. Decarbonisation is our second one. As I said, decarbonisation dominated the discussions I had over the last year and a half. It started with people wanting a decarbonisation strategy. What it's moved into, thankfully, is people saying decarbonisation needs to be a factor in our strategy, and we need to work out what we're going to do to allow for this, which is really positive. The big miners have all committed to net zero by 2050. Most know broadly how they're going to get there, but specifics are still there. It's rather like Australia's commitments. There's part of it that depends on technology advances that haven't happened yet. So there is a little bit of a way to go. The great thing for Australia on Scope 1 and Scope 2 emissions is because a significant part of our carbon is caused by the power that we use on sites and the diesel that we use on sites. So unlike the Northern Hemisphere where they use a lot of renewable energy already, we tend to use generated energy from either diesel or coal, and so switching that to renewable energy will have a significant impact on the carbon you produce at your own mine site. Scope 3 is a different matter. And what I think we'll start to see is a lot more people wanting to control the way that their products are used. So whether that's deciding who they sell to, whether that's managing some of the beneficiation yourself, so whether that's taking iron ore and turning it into iron, whether that's using some sort of leaching process, whether it's a direct induction process, or whether it's using hydrogen in the future to be able to do that reduction close to site. That would then mean that you're selling iron. There would be less carbon produced when that's turned into steel, and you'd also reduce your Scope 2 emissions. So I think there's some quite positive things there. A couple of issues in terms of getting to net zero for us. No carbon price makes it hard. I think there effectively will be a carbon price within a year or two. We've seen the OECD move to put some standard tax provisions in place. We think they'll do similar things with carbon pricing, and that'll mean there's effective floor for carbon pricing, so that will help put that carbon price in place. The other big one that you need to sort of think about is the fact that at the moment, when we calculate carbon for a mine site, what we do is we calculate it on the basis of inputs. So we say, how much power do we use? What's the carbon attached to that power that we either generated or we purchased? How much diesel do we use? What's the carbon that's associated with that? That must be our carbon. And then you allocate that across the value chain on the basis of some sort of basic algorithm in terms of what's there. You don't go into the detail and say how much carbon does that truck use compared to that truck? How much carbon do we use in the screening circuit as opposed to the separation circuit? And what does that look like? And the problem in not knowing the detail of that is when someone comes to you and says, we've made some innovation, we have a technology advance, we believe we can reduce your carbon by 6% if you compare it to this one. Your ability to test that is limited. So being able to understand carbon at a step-by-step basis through your value chain is going to be really important. So operators need to sort of start thinking about that. OEMs need to start thinking about how do I publish that in terms of what I'm doing, and all understanding it at all levels is going to be important. Talked a little bit about Scope 3. As I said, if we can manage what we're doing around Scope 3 in terms of putting some beneficiation in, I think we're going to be better. I think on a number of bases, increase in beneficiation will be positive. We missed out when we developed our industry in the sort of the 60s and the 70s. Renewable power should make that easier and should be big in terms of what's there, because I think that's going to be really critical. There will be first mover advantage to people who can manage Scope 3 emissions. You're going to be more attractive if you can do those sort of things. So there's going to be a business benefit if you're able to manage that benefit. Our third issue is license to operate. License to operate's been our top issue for the last couple of years. Looking at it continues to broaden, and it continues to be an issue in terms of what's there, and we're continuing to see impacts globally. So I think, broader consultation with traditional owners and understanding what they require is going to be critical. We had a number of our respondents say that this was the number one issue for them in 2022, but also being able to demonstrate positive societal contribution. So what is it you're doing? License to operate is the critical thing to fix our brand as we move forward. And we need to be really focused on taking our brand forward. We've taken a number of hits over the years. We're taking more hits this year in terms of what's there with brand. But people in the industry know that we are progressing on some of these issues, and we are doing good things. So we need to talk about that. It impacts everything. It doesn't just impact our ability to access land. It impacts our ability to attract great people to the industry. It impacts our ability to attract capital. It impacts the fact about whether banks are going to want to give us short-term finance or working capital, about whether insurance companies are going to want to take risk on our assets. It is so all pervasive that we're going to have to do something about this. So getting long-term license to operate right is going to be critical as we move forward. So you can see we've tended to think about those three together in terms of what's there, and I think thinking through response to those together is really important. They all go to our brand, they all impact the next couple of issues that we'll sort of talk about, and they all impact the way we operate. They need to be an integral part of your corporate strategy, as I said at the start. So I don't like seeing a decarbonisation strategy or a community strategy or something like that. They're plans and they're actions. A strategy needs to be at a higher level, and these should be factors that are driving your strategy. We're seeing a great top-down approach. Boards are asking questions about this. They're far more knowledgeable. CEOs are far more knowledgeable, and that will increase in terms of what's there. Our advice is to focus on creation of long-term value. So to start to understand how non-financial value or long-term value is generated and how that can be shared, and start to understand how you share that across your various stakeholders. So whether that's the society within which you operate, your community, your other stakeholders, your suppliers, those sort of people in terms of what's there. Thinking long-term value rather than short-term value is going to be critical. That's generally been tough in a market that demands quarter by quarter, but capital markets are now understanding that if they drive for quarter by quarter, they're not going to get the outcome that people want. And the reason for that will go through in capital, but it's because capital markets are now driven by pension funds and superannuation funds. So we're starting to see different behaviour in terms of what's there. Identify issues that will both drive and destroy value and manage those hard. And as an industry, we need to build brand. So communication and consistent action is really critical. What we're seeing around the world is jurisdictions acting extremely consistently. So if we see an issue in one jurisdiction, we see response right across the board. That didn't used to happen. You think back 10 years ago, if there had been a dam failure in Brazil, it would not have impacted tailings dam standards globally. It would have just been an impact in that province where the issue occurred. So these things are starting to happen as we move along. Really important in terms of what we do. Risk number 4 is geopolitics. We'd already started to see this as a rising issue. Here in Australia, it's hard not to think about this as China in terms of what's there. The China situation is really interesting. I mean, a lot of people sort of said, the China actions in terms of our exports and those sort of things were a reaction to, we were the easy country to punish because we were close to them and because we weren't the US. The US has been the big beneficiary of the blocks that have been put on our exports. So it's been a really interesting impact. But China's importance will continue to grow. So, while the rate of growth is slowing in China, what we're seeing is China's interest in being external is continuing to grow. Through initiatives like Belt and Road, through initiatives to secure supply of critical minerals, through initiatives to increase influence. And at the same time, the influence and the role that the US wants to play externally is reducing. Now, I think, 2-year election cycles in the US, the president might be 4, but there's half terms every 2 years, means that the US government needs to look more and more internally. We all remember back to the election in 2020. The states that swung the election were those ones in the middle and those ones that swung. And those are the states that don't like a US government that says we're going to invest in South America, we're going to invest in Asia. They want investment in the US. And so, it's increasing nationalism right across. Other things that are increasing nationalism are what we're seeing in terms of change of governments, particularly in South America. So we've had a change to more left-wing governments, both in Chile and Peru. Both have talked about some sort of resource nationalism. We don't believe it will happen in Chile. We think that the government in Chile realises how important it is. We're a little bit worried about Peru. And there's a presidential election due in Brazil in August. And it's expected that there'll be a change of government in Brazil during that sort of time. So, South America has been our big focus for investment for a number of companies the last few years, particularly with the abundance of copper. If that starts to become politically risky, then it'll be interesting to see both what the impact is on the price of copper, but also on the availability of new resources in terms of what's there. We don't think there's going to be a resource tax in Australia. We think there's despite the fact that there's a big debt because of COVID response. We believe both sides understand how important the mining industry has been to the country, and that blunt instruments don't work. We saw that when we tried to put the resource rent tax in. And so we don't believe something like that will come through Australia and will be relatively safe. But security of supply is going to be really interesting. You're going to see more and more investment as we go around. Number 5 is capital. Capital's probably been the most consistent issue in our top 5, and it's really interesting. Capital drives this industry. It's critical for exploration, it's critical for building developments, it's critical for developing markets in terms of what's there. But access to capital remains challenging in terms of what's there, and particularly because of those first 3 factors that we saw in the risk list in terms of what's there. So because of those ESG factors. We saw sort of 3 years ago, we sort of started to see some funds say that they were not willing to invest in extractive industries. We tended to ignore that a little bit. It tended to be, it was the famous sort of first mover was the Canadian Teachers Fund. And I think most people in the industry sort of went, Teachers Union in Canada has probably never been that supportive of us as an industry anyway, who cares? Then 2 years ago, you saw the Norsk Fund come out and say that they are going to wean themselves off extractive industries. I mean, that the economy of Norway has been dependent on that fund for years, and on what's happened in the North Sea shelf. So it was a really interesting one. And then for the last couple of years, we've started to see fund managers like BlackRock and those sort of people come out and make really direct and concrete statements about what they want to see around ESG. Why? 40% of capital markets is now in pension funds. So it's mums and dads who want their funds to be invested properly, and 20% of capital markets is sovereign wealth funds. So you've got 60% of these markets that are driven by society and driven by societal factors. So it shouldn't be any surprise that capital markets are now starting to reflect what's happening in society. So they're not the capital markets of the sort of the early 20th century where they were dominated by wealthy individuals. Capital markets are now much more democratic, much more widespread, and they reflect what society thinks in terms of what's there. So really interesting one to sort of think through as you sort of think through those things. We've started to see an increase in exploration budgets, which is great. In terms of what's there. And I think that's particularly as we've seen more certainty around prices for things like lithium and cobalt. So I think, if you went back a couple of years ago to try and get a price curve for lithium or cobalt, it was virtually impossible. And it meant that people didn't want to invest capital in it. You're now seeing some stability in that. You're seeing some good prices, so you're starting to see it. And we've started to see reinvestment in things like nickel and zinc and those sort of things that are going to be what we need for the third phase of the energy transition when we need to store. So, big one in terms of what's there. I think, if we do move into a bit of a boom, we've already seen some workforce factors, and workforce was one of our risks that came up already. So I think if we do start moving into a new building boom where we're going to start constructing new mine sites and doing those sort of things, capital discipline is going to be really important. So making sure that we manage that capital discipline and we don't go over budget is going to be really critical in terms of what's there. We've tended to make mistakes in the past, and those mistakes impact your return for the life of a project. So getting that right is going to be really critical in terms of what's there. So that's our top five. As I said, you could almost call it five external factors in terms of the market. So really interesting compared to other years, compared to what we've seen. We had two new risks this year that came through. The first one was uncertain demand. So we've had volatility on there before, which is interesting, but uncertain demand's a bit different. So, we're not seeing volatility in products for reasons that have sort of happened in the past. So for your traditional factors of supply and demand that have impacted it. One of the big things that's impacting demand and prices has been innovation. So it's been this uncertainty around what will be the winning product and what will it look like. So an early view that coal was going to phase out much quicker than most people now think it is going to do saw the price of coal come down. As people have realised that coal actually probably has a much longer life than we expected, and particularly the high quality coal that we have in Australia. So, low impurities, high calorific content coal is going to have a role for some years. The blast furnace isn't dead. It's going to go for some time. And I think even when hydrogen first becomes commercially possible, you're going to see a mix of coal and hydrogen in terms of what's there. So moving to fully, carbon-free steel industry, I think is still some way away in terms of what we're looking at in those sort of things. We also then saw supply challenges. So we saw, complexity from geopolitics, complexity with supply chains, complexity in terms of getting ships to take product away, complexity in terms of actually being able to keep mines running, both with COVID and getting supply chains to work. All those factors sort of led to uncertain demand. So I think, these sort of things are going to drive on. The big one will be changing customer needs. And the good thing for us as an industry is they'll tend to be faster than we thought. So people are now saying tipping point for electric vehicles will be in the next 3 or 4 years. I can remember when that was 2050. That was only a couple of years ago. They're saying the tipping point is going to be very soon in terms of those sort of things. So I think while innovation will cause uncertainty, I think in the long run it'll be positive for us as an industry. Our second new risk was new business models. And this is a really interesting one. And when we did our own webcast, we had Mark Cutifani on. And Mark talked about this a lot. You know, when disruption happens in an industry, you tend to need to change your business model in terms of what's there. And so I think, we are going to need to see miners start to think about what does their business model look like. Vertical integration is an obvious one, and I think beneficiation is going to be a key part of it. I think if you're a lithium miner, you're going to be in a much better position if you sell lithium hydroxide than if you just sell lithium. I don't think mining companies should get into manufacturing batteries, but I think if you've got a nice cheap supply of renewable energy on site, producing something like lithium hydroxide is going to be very, very easy. So I think that sort of vertical integration we're going to see in terms of what's there. COVID and uncertainty has scared people, so horizontal integration, so buying suppliers, buying logistics companies in terms of what's there. We've seen a return to shipping from a number of people because of uncertainty in that. We're going to start to see those sort of things. But then I think, the other bit is going to be, joint ventures and different sorts of agreements. How will you operate with a country that wants to nationalise its own resources? What will that look like? Mining as a service is something I've talked about for a couple of years, and I think mining as a service is going to be something that mining companies have to think seriously about, but also other players, the other sort of people in the met sector need to think about who would you collaborate with to provide mining as a service, because I think there's going to be great value in that going forward. And then 3 other issues that we've sort of had on there before, so don't propose to spend sort of too long on there. Digital and innovation was obviously our number one for a number of years. Look, it hasn't gone away in terms of what's there. Miners are actually accelerating investment in digital. They've spread it. So when we first started spending on digital and innovation, quite frankly, we saw the vast bulk of that spend was on productivity. It then went into safety. So good from an LTO perspective. We're now seeing it go into ESG. So investing in digital, understanding what data you need to be able to make decisions around ESG is going to be more and more important. Development of green products is going to be a real important one as we sort of move forward as well. Workforce, border closures have not had as much of an impact as I thought they would, but have created issues at mining companies. I'm sure there's a lot of people that would disagree with me that it sort of hasn't created as many issues as they thought. I think too, we've started to see, particularly in the last few months, that need to not just build a diverse workforce, but to build a safe and inclusive workforce is going to be really critical to attract the future talent. And talent is critical to drive the industry. And then we can't have a top 10 risk report without having productivity and cost reduction on there. We did incur costs because of the pandemic, without a doubt. We've had some high supply chain costs in terms of what's there, but then we're also seeing that need to decarbonise. Operations has increased costs, but the one I always remind my team about, the ton of ore we extract tomorrow is more expensive than the ton of ore we extracted yesterday, and costs always rise if you don't change anything in the mining industry. That's the one given that we have as an industry in terms of what we do. I've gone 40 minutes on that. There are a couple of questions in terms of what's there. So let me just try and address some of those quickly. So yeah, the first question is about distinction between license to operate and the S in ESG. Look, not a lot of difference. The way we've tried to distinguish it in the report is we've said license to operate is more the community and those that are directly impacted by the mine, whereas the S is the people that are more indirectly impacted by the industry as a whole. So, if you sort of think of the LTO is the traditional owners and the community that live close to and provide workers for the mine. The S is the state or the province and the country that takes royalties and takes tax. Not scientific. We just tried to distinguish it because both came out as important issues in terms of what we do. Trends are definitely global. We get responses from all of the big mining areas. We particularly had great responses this year from Chile and from Canada. Australia's been a traditional source, but we also get great responses from South Africa, from London, in terms of people that that are based there. So it is very broad in terms of what's there. So I think that's going to be really interesting. Third question, I'm just conscious of time, is that smaller mines often can't compete from a productivity perspective due to a lack of capital and scale. How would they be better positioned to compete from an emissions perspective? Look, I think as long as you're able to procure renewable energy simply and easily in remote areas is probably going to be the critical part to making sure that smaller miners are there. Larger miners will be able to generate their own power for renewable energy. Significant government investment will go into renewable power generation. I think as we see us move out of COVID and we move out of having to support economies and get cities reopened and those sort of things, we're going to see continued investment. I don't think we'll see governments clamp down. They're going to try and grow out of this debt, out of the debt that's been created during COVID. And I think a lot of that investment will go into creating renewable energy infrastructure that can create jobs. So a bit of a mouthful, but I think that's where we're going to see it, and that would be very interesting. Price point for hydrogen, not yet. I haven't sort of seen one in terms of what's there, and I think we've got to sort of think through that hydrogen will have different uses. So whether it'll be hydrogen as a fuel source for operating trucks. Anglo American's been running some very successful trials, whether it's hydrogen as a storage product or whether it's hydrogen for beneficiation. I think the hydrogen for beneficiation miners will generate themselves, particularly the early ones that are going to do it. But I think the others, they'll be purchasing it in terms of what's there. And the last question's on uranium. Look, I do think there's a role for nuclear energy moving forward. The world hasn't quite accepted it yet, and there will be certain countries that will avoid it. Think Japan in terms of what's there. But particularly for the northern hemisphere, where the sun doesn't shine as much as it does here, and the water freezes for your hydropower, I can't see how they're going to get away with meeting renewable targets without nuclear power. And so, small scale, safe in terms of what's there. I do think there's a positive future for uranium mining, but there's some way to go until we get over some of the issues in terms of what's there. Hopefully I've answered the questions. Hopefully I've left enough time for Sheldon to wrap up. Hope you found that interesting, and thanks very much, everyone. Over to you, Sheldon.
Excellent. Thanks a lot for that, Paul. That was fantastic. You've done well to fit all of that content into 45 minutes there. Pages and pages of notes at my side, and particularly interesting to see that overwhelming response with those first three challenges, first three risk and opportunities in particular. So thanks a lot for that. Yes, before we go, I would like to encourage everyone to tune into our webinar next week. That will be on the year ahead in the met sector. So taking more of a look at some of the major supply chain trends. So we have panelists there from Maptech, BHP, Atrico, and GHD, looking at some of those market trends, technology merger and acquisition activity in the met sector, supply chain engagement with ESG challenges, and some other issues as well. So definitely, if you're a part of the met sector, I encourage you to tune into that. Once again, a big thank you to Paul for your presentation today. If you do want more information or you want to see the report in full, that is available on the EY website. You will also get a copy of the recording into your inbox this afternoon for those who have viewed the webinar. So thanks a lot for joining, and we'll see you at the next Austmine webinar. Stay safe, everyone.